Hello and welcome back to another episode of the Investor Financing Podcast. And I'm your host, Beau Eckstein. And on today's show, we're going to talk about financing 2 to 4 unit properties and a couple different financing techniques to acquire these properties. Okay, so let's get started. First, we're going to look at what is the occupancy level of this. Let's call it a fourplex. Is it currently 3 of the 4 units are rented out, or 2 of the 4 units, none of the units rented out? We're going to start there. Okay. That's the first question we need to know. Second question is, do you need to rehab the property? What's the construction budget, or is it pretty turnkey? We need to know if you're planning on putting any CapEx into the property off the bat. Lastly, what is the property worth when it's fully stabilized? Meaning when it's rented out or fixed up, what is it going to be worth stabilized with tenants in? Once we have that, obviously we need the property address, the purchase price, your credit score, and that's how we basically size up these 2 to 4 unit properties. Now, you can always refinance or purchase these properties rather with conventional financing if you qualify with from a DTI standpoint and so forth. What we talk about mostly on this show is not the conventional loans with Fannie and Freddie, but we talk about DSCR loans and investor type of loans, where we're able to make loans to your business entity, and it's based on the debt service coverage ratio of the property, and it's based on your credit score and LTV. That's how these are priced out. So in these 2 to 4 unit properties, there's many options. So potentially, if it's a vacant property and there's a heavy value add, you're going to finance these with bridge financing to acquire the property, to renovate and to lease up the property, and then refinance. But let's say 2 of the 4 units are rented out, and the income from those properties are sufficient to qualify you from a DSCR standpoint, from a debt service coverage ratio standpoint, then potentially you could just go right into a rental loan. So it really comes down to the strategy you're looking for, the property type, what the current situation is. And that's how we kind of navigate the waters of what might be the best financing.
You're listening to the Investor Financing Podcast. We'll be right back after this break.
Hello, Beau Eckstein here, host of the Investor Financing Podcast. Are you a lender, real estate professional, or vendor that provides products or services within the real estate investing and business owner space? We are offering a few sponsorship opportunities to get in front of a highly targeted audience. If you're interested, please click the link below for further information. We look forward to talking with you. Thanks. Make it a great day. A lot of people go into bridge financing because they're buying low, and they know when they do their value add, they'll be able to refinance and pull some of their initial equity injection back out of the property so they can continue doing this. This is a standard BRRRR method. So depending on the strategy of what you're looking for, that's going to dictate. Now, right now, with rates maybe going up in the future, does it make sense to lock into a rental loan off the bat, a 30-year fix? Potentially, yes. So we got to look at these strategies, how much value add is really going to be created, or are you just buying something that's a solid cash flow property and it just makes sense to go straight into a rental loan and there's enough debt service coverage to support the loan request you're looking for. Now, let me also throw something else out there. Even if it's not rented, but it's in rentable condition, we can do a rental survey and use rents that are going to be coming on from a long-term rental standpoint. So what that means is when they come to do the appraisal, they're going to do a rental survey. And let's say that unit will rent out for $1,500 and the other will rent out for $1,300. The appraiser notes this in this rental survey, and the lenders will actually go off of that. Sometimes they give you a little bit of a haircut on loan amount and so forth. They each have a little bit of a different underwriting matrix. So potentially, even if only 1 was rented out or 0 were rented out, but it was a rent-ready condition, you could potentially just go straight into a 30-year rental loan. So anyways, there's lots of options. It's really scenario-based, but it's pretty simple when we get in and kind of get the basics from you, the potential borrower. So that's what we do. We figure out the best scenario, which lender would have the biggest appetite for that particular deal with the best rates and terms. And there's also options to do interest only, to do a shorter fixed rate period where the rate might be better. So it really kind of depends on what's your strategy. You're going to hold it long-term or turn around and sell it in the next 3 to 7 years. So anyways, thanks for watching another episode of the Investor Financing Podcast. Always please like, subscribe. It helps me get in front of more people on YouTube that are looking for financing tips and tricks. Anyways, have a great day and we'll see you on the next episode.